alone is a powder keg. But now you sprinkle AI on top of it, this becomes something else entirely. Because here's the thing, it's a real economy CapEx explosion. According to Gartner, global AI spending will reach close to $1.5 trillion this year and will top $2 trillion in 2026. Data centers, chips, infrastructure, energy, semiconductors, the demand is enormous and persistent. Look at this. JP Morgan global data center and AI infra spend to hit $5 trillion. NVIDIA becomes first company to reach $5 trillion valuation fueled by AI boom. This is a global capital rotation. Corporations are spending like crazy to build the next economic layer of the world. And here's the macro part people are missing. This AI movement isn't optional. By 2030, data centers are projected to require $6.7 trillion worldwide to keep pace with the demand for compute power, which means this spending pushes GDP up, pushes earnings up, pushes valuations up, pushes liquidity needs up, and forces central banks to accommodate. If you're a policymaker watching trillions flood into AI infrastructure, you don't run restrictive monetary policy into that. You support it. AI is effectively demand pulling liquidity back into the system. And now we bring all three forces together. When you combine political gasoline, deficits, tax cuts, checks, voter incentives, and the 2026 Fed chair transition with liquidity engine shifting, like quantitative tightening, the balance sheet stabilization, repo stress, signals of future expansion, everything we've been talking about, and the AI supercycle, you get what I would call a macro environment that is fundamentally incompatible with a sustained multi-year risk-off cycle. Volatility? Yes, probably. Pullbacks? Probably. Scary periods? Probably. When does that ever end? But structurally, this is the exact setup that usually produces the biggest upside moments for risk assets. And crypto is the furthest out on that curve. Check this out. Bitcoin's correlation with global liquidity is not only strong, but also has the highest degree of directional consistency with global liquidity conditions relative to other asset classes. I want to show you a couple more headlines. Citigroup strategist wrote, Bitcoin is a more sensitive instrument for pure liquidity. And with the Fed stopping balance sheet runoff in December, that liquidity picture is about to change. One analyst put it simply, 2025 to 2026 still look bullish. Global liquidity is rising once more. Japan, China, and the US are all adding money in their own ways. It's not just another year, it's the convergence point. The pipes, the politics, and the technology all point in the same direction.